See silver probably making over 60 this year. I mean, we've got 1 month left. We could probably get another couple bucks on it here within the next 4 weeks. Longer term, I do still think we're in the acceleration phase. So if we top out in a year and a half or two, I don't know. I mean, I'm on record in 2003 putting in writing that I saw $100 silver this time. And that was when silver was at 20, excuse me, at $5 a little under that. So I was looking for a 20-fold increase from the year 2003 to wherever it ends. If that trend continues, then I'm suggesting that it will. We could be getting to the top here very soon, especially with what I wrote in the editorial that I sent you.
Silver is charging into territory the market hasn't seen before, and it's doing it fast. Trading near $60 an ounce, the metal is showing the early signs of what David Morgan calls the acceleration phase, the moment when prices stop grinding higher and start moving in sharp, dramatic bursts. He thinks this isn't the end of the move, it's the beginning of the volatile stretch that usually precedes a major peak. Gold has already made its case. It doubled from the 2000 level to more than 4,400, and the door is open for 5,000 if global monetary stress deepens. Some analysts even float numbers between 10,000 and 20,000 in a full-blown crisis. Silver, though, is acting like the real firecracker. It shot from 30 to almost 60 in a short window. That kind of doubling is what you typically see in the late stages of a bull run, when momentum takes over. Morgan goes back to a call he made in 2003, when silver was under $5. He argued that $100 was possible in this cycle. With the metal now pushing past its old highs, heavy ETF inflows hitting the market, and traders bracing for a Fed rate cut, that target no longer sounds far-fetched. The pattern looks a lot like the 1970s run, where both metals moved from steady climbs to outright panic buying. He also reminds people that the real market is driven by derivatives and commercial bars. 1,000-ounce bars moving through London, New York, and Shanghai set the global tone. 4 months, demand for deliverable metal has outpaced supply in the right hubs, creating repeated arbitrage opportunities, a sign of tightness that often fuels the kind of acceleration we're seeing now. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Well, first of all, I think the public thinks that the silver market is basically the retail market. So they buy silver at their local dealer or through the web with well-known notables like Miles Franklin as an example, and there's several. And that is definitely part of the silver market. But the real silver market is a derivatives market, like all commodities. So it's basically a huge amount of paper contracts that go ebb and flow, up and down, with a lot of professionals that are very good at, let's say, capturing small movements and making large money because it's so leveraged. And I don't think people really understand that part of the market or how it actually operates. And then on top of that, the real silver market not only being run by derivatives, but the fact that 1,000-ounce commercial bars are the true silver market. In other words, that's the price that's discovered by the contracts sold on the futures exchange. It's there in London, it's in New York, and of course, there's the Shanghai Gold Exchange that does something similar. There are other smaller markets. And so I think the misunderstanding can be that what drives the silver market is perhaps the retail investor buying silver. Certainly that has an effect, but the real effect is the commercial bar market. And we're in a position now that is what's new is that demand for commercial bars exceeds the supply. Is it momentarily or is it from now on? I do not know. What I do know is momentarily, meaning the past few months, there's been a mismatch between the amount of physical silver available at the right location at the right time. And this has produced discrepancies in price discovery, meaning that there's an arbitrage opportunity. Arbitrage means it's a given commodity or stock or house or whatever that's identical or fungible, and it has a different price in a different area. And so you take the product to the new area and get a higher price for it. That's an arbitrage. And that's been happening in silver a few times here lately. which is rare to take place, especially this often. All markets move at the margin, as you know, and the margin for silver is at the monetary demand. But the industrial demand has gone up very, very rapidly in the last 25 years, which sounds like a lot, but in human terms, but in monetary terms, it's nothing. So if you go back 25 years ago, 35% of the market was industrial demand. And at that time, we only mined 550 million ounces on an annual basis. Today, industrial demand is probably pushing 70%, and we mine 850 million ounces now. So think about that. The amount of demand 25 years ago was 30 of 50, so maybe a couple, 250 million ounces. Now, 70% of 9 is like 600 million ounces. So that doesn't go away. Now, in a big recession or a global contraction, it could mitigate it somewhat, but not that much really. Now, the calling card is the monetary demand, and that's where the retail has backed off. I just checked again today with a couple of the big wholesalers, and they're still buying back more silver from retail than they're selling. But bigger institutions, as you outlined, Michelle, are buying silver for monetary purposes. And the industrial demand, I think, is where I've talked about for years, which means when that point in time happens, where industry and monetary demand come together at the same time, we are going to see an explosion in the silver price. And it's basically more industrial right now, I'd say, than monetary, at least from the retail side. But both demands are there and accelerating. And this is something that in a very small market like silver, you could see these extreme moves, which you've seen the last 3 or 4 days, where we go from, it hit 54 and it comes right back down to the 50-day moving average. And then all of a sudden it goes past 54. We're sitting near 60. And that's the silver. I don't know. Price predictions are so difficult because there's so much funny money out there that might be seeking a safe haven that's really hard to anticipate or calculate. But I do think when the mainstream media puts me back on CNBC, you might be consider selling some of your silver holdings. But I would say on gold, I think 5,000's a gimme. I think it'll make it to at least that level. Could it make it to 10? Yes. Could it make it to 20? Yes.
In what time frame?
Oh, I'm still looking at, near term. I'm looking at acceleration phase. I mean, you may have heard me. I don't know how much of my podcast you've heard. I'm sure you're very busy, but I've said over and over again that 90% of the move comes in the last 10%.
Mm-hmm.
So if that's true, and this market started in 2000, we're in 2025, what's 10% of 25 years? 2.5. And if that's 90% of the move, and that's not an exact term, but it's the idea of the acceleration. Look at how long it took to go from $2,000 gold to 40. Look at how long it took to go from $30 silver to $60 silver. Not long. If that trend continues, and I'm suggesting that it will, we could be getting to the top here very soon.
Industrial demand has completely reshaped the silver market. 25 years ago, only about a third of silver use came from industry, and global mine supply sat near 550 million ounces. Today, industry accounts for roughly 70% of all demand, while annual production has climbed to about 850 million ounces. Even with that increase, around 600 million ounces are being pulled into industrial uses alone. That's the force tightening the market. And even if a recession hits and factories slow down, the market tends to correct itself. Most silver comes as a byproduct of base metal mining, so weaker industrial activity would automatically reduce supply and keep the deficit intact. But the real swing factor is monetary demand. Retail buying has eased lately, wholesalers are seeing more people selling back than stepping in, yet big players have quietly been accumulating silver for strategic reasons. Morgan warns that when strong industrial demand meets a revival in monetary demand, the price response can get violent fast. You've already seen hints of that. Silver touched its 50-day moving average, looked like it might cool off, then ripped through $54 and pushed toward 60 in a matter of days. These whipsaw moves fit the pattern of an acceleration phase, the moment in a bull market when prices start rising in tight, compressed bursts. Let's get back to the video.
I think silver is such a maverick compared to gold. I mean, gold is truly an establishment metal. although you won't hear that from many people other than myself and perhaps some of my peer group. But it is the money of last resort. Central banks have still continued to buy it. It's their money as kind of a backup position, as we could keep talking about on the CBDC. It's the money of last resort. It's been money for thousands of years. It will continue to be so. And the banks use it because they know that if all else fails, there's gold. Now, silver used to have that role, but it hasn't basically since the crime of 1873 when silver was demonetized in the United States, although at one time the world was basically on a silver standard. So I think that it doesn't have the punch that gold has, and it's also a very small market. But I did smile, you might have caught it, because of all of those names that are so well known, so well respected. If we did go into a big recession, there would be less demand for almost anything. And that could curtail the silver market. But from a bigger perspective, it's almost self governing. And what I mean by that is 70% of the silver supply comes as a result of base metal mining, 12% comes from gold mining. So if there's a big recession, you're going to see less need for copper, lead, zinc. And because of that, it's going to kind of mitigate it all by itself. In other words, if the mining activity slows by 10%, and the industrial demand slows by 10%, the mining activity is going to kind of match the need anyway. So I'm really not that concerned about a recession, especially from the aspect that we've been in a deficit for the last 4 years, perhaps 5, and that deficit could go from 200 million ounces down to, let's say, 100 million ounces, but you still be in a deficit. So that part really doesn't worry me that much. In the acceleration phase, you will see, as the name implies, larger movements rapidly. And obviously, the market's going up, doubling in a year is something you haven't seen in silver until the final phase of the earlier bull market that went from basically 1970 to 1980 in gold. And I would argue from 1966 or 65 to 1980 in silver, because silver was basically demonetized out of circulation in 1965. So the final phase is when you get the panic manic phase at the very top. We're not there yet. We need to see the public come back into this market. But when they do, it'll be, unfortunately, from history, it'll be more on fear than greed. It'll be fear that the dollar's losing value, fear that I don't have enough for retirement, fear that my pension plan won't be there, fear that my IRA is going to be taxed beyond what they originally said. I mean, there's all kinds of things I can make up, some of them legitimate, some maybe out in the weeds. Nonetheless, the point being that fear drives a market harder than any other emotion. And I don't like to see it, but I do know the markets. And I do believe that's what we're going to see within the next couple of years. And many people say, well, the silver deficit that we've talked about will guarantee, well, they haven't used the word guarantee, suggest strongly we have a 10-year bull market. On fundamentals, I agree with them totally. But being a student of the market since I was a 16-year-old kid, I'm well past that now, we're in the acceleration phase, and it doesn't last long. We get a big movement in a short amount of time, and this is what we've already entered.
As this market takes shape, silver is behaving like the outsider it has always been. Gold sits in the role everyone expects, the establishment metal, backed by central banks and tied to centuries of monetary tradition. Silver lost that standing more than 100 years ago, and ever since, it has moved through a smaller, more volatile market that reacts sharply to industrial trends and investor emotion. That mix makes it far more explosive than gold, especially when anxiety creeps into the financial system. Late-stage public buying in silver rarely comes from simple speculation. It's usually driven by fear of currency erosion, fear that savings won't hold up, fear that pensions won't deliver. If those pressures intensify over the next few years, silver could slip into the kind of manic phase that has marked every major blow-off in its history. The bigger question now is how fast the upper limits can be reached. Acceleration patterns are shortening, supply deficits are widening, and institutions have been quietly building positions. Put together, the groundwork for outsized moves is already visible. Whether silver pushes toward $100 or gold climbs into the higher band of Morgan's projections comes down to how violently industrial and monetary forces collide. And if past cycles are any guide, the most dramatic part of the run usually shows up right before the peak, which raises the real question: how close are we to that final, defining phase? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.